let's there are times in macro, a lot of times the macro world kind of sort of goes sideways for I would say sometimes years, and then all of a sudden you have something that unfolds, a war, or sometimes it could be just a shock in markets and macro assets, and lack of volatility that, or I should say, of volume in a certain asset class that creates a shock, exogenous shocks, and so forth. And all those things usually creates an environment where creates a lot of dislocations and sort of things that we've been waiting for start to unfold. And so Kevin has been busy as well because of I think there's a lot of things that are going on right now, and those are the times that usually that I think we do our best work personally. So stick with me here, because I was listening to an interview the other day of a technology investor, and he claimed he was talking to this legendary investor, and he asked this guy, how was your asset allocation on equities exposure wise in early 2023? And he said, I was about 80% long equities. And so he asked the next question, how much were you long coming into 2024, early 2024? He said, about 40%. He took profits. And then he said, what about now? How much do you have in equity allocation? He goes, oh, right now it's zero. So, it's an interesting story. Some smart investors, they know, they don't know exactly the timing of things, but they know when things get a little frothy. So let me talk about some of the things that I think are interesting in this environment. This is a chart of commercial industrial loans, and it's going to set the stage for some of the things we're going to talk about. One of them is this chronic issue we have with treasury markets, which is at the core of a lot of the problems we see. But commercial industrial loans is interesting because it's basically sort of what drives the economy. So you have banks and they lend money to institutions. Those institutions then create growth, supposedly. And we've been through a trend that we haven't seen any lending whatsoever across commercial and industrial loans. And it begs the question, why is this happening? I showed this chart last week, and I want to sort of work through it on the reasons for that. I think the one main reason is a deeply inverted yield curve. That's number one. Banks are not incentivized in an environment where long-term yields are lower than short-term yields. It makes it very difficult for any lending institution to lend capital. And so that is one of the main things. The second thing is actually what's happening. We usually see these things happening with emerging markets. It's almost like the US and other developed economies are turning into emerging markets, believe it or not. So let me explain a little bit what I mean by that. In emerging markets, and I come from Brazil, and I've seen this many times, and not just in Brazil, it happens in China, actually, and other emerging markets too, where you have this failing business or a business that is just struggling to grow, that has become too big at some point, and now it's struggling to grow. And guess what happens during that period? The government starts to intervene. It starts to acquire higher percentages of that business over time. Now, I'm not saying here that the government owns U.S. banks, but the phenomenon I'm about to show you, it's really intriguing. Let's go to the next chart. You're seeing here in the white line that banks are starting to buy treasuries again. Now, maybe they've been instructed to do so. Maybe they're doing it in their own, desire. I just shocked to see anybody interested in buying those instruments, to be honest. But nonetheless, the white line now, you're seeing basically the ratio between the prior chart and their ownership of treasuries. In other words, today, U.S. banks have about 150 or 1.5 times more in their balance sheets of U.S. treasuries than what they have of loans for commercials and industrial purposes. And this is, sort of fascinating because, throughout history, we haven't seen really banks have that much of U.S. treasuries relative to, I think the 1940s is one of them. And the prior week actually talked about that, where, one of the ways to deleverage the economy at that time was really the government running a primary budget surplus at that time. What is a primary budget surplus? You take the budget deficit and you take out interest payments, and that's basically what that is. And today, it's sort of unthinkable to see an environment like that with onshoring and green revolution, defense spending. No, we're not at the end of a deglobalized environment. We're at the beginning of one, most likely. So it is sort of crazy to see that banks are not lending anymore because they're being forced essentially to buy U.S. treasuries. And maybe not. Maybe I'm wrong. Maybe they just, again, deliberately want to buy treasuries because they think that's there's a value proposition to be doing that. I highly doubt that's the case. Let's go to the next chart. And so it brings me to something that is contrary to the gold space, in where we're seeing gold market really take off. Gold prices have taken off and making new highs. I still remember the people that doubted the triple top, and the triple top now is past. And we're way higher levels than we were back then. But what is interesting about this is that we're not seeing the same level of commitment coming from general investors, meaning general investors are not buying into gold. Therefore, we're not seeing a very large amount of that translating into a growth in the ETFs of the world, like GLD, which is still the most liquid ETF in the world, that is increasing assets under management. Now, contrary to the gold market, and the reason for that is because central banks are accumulating gold, not general investors, we're seeing a very opposite trend in the U.S. Treasuries, where if you look at the most liquid ETF for Treasuries, TLT, which has a long duration of a longer duration than the usual vehicles you find to invest in Treasuries, meaning they are invested in most longer term Treasury instruments. You can see here that the white line is showing that the assets under management of this instrument are still rising while the prices of TLT have been collapsing. And this is such an interesting thing because, to me, if you go to the next chart, I think the next chart has this. Oh, maybe it doesn't in this one. But even fund manager surveys are showing today that treasuries have been one of the most overweight that they've been in many years. And this is still the case. So the general investor still carries a large weight in U.S. Treasury, despite this idea or the factual thing that prices have been declining. To me, this shows how investors are still conditioned to really be hedging their large exposure to equities, in which that legendary investor, whoever that was, said they hold 0% with U.S. Treasuries and not gold. And so gold has been sort of gone in the sidelines. We haven't seen really people use that as a form of hedging their risk. And I think we're in the process of seeing this shift, especially with the performance of gold relative to treasuries improving drastically. Now, I went through a few presentations ago. I went through kind of what I thought was interesting to kind of break down what's causing U.S. treasuries to rise, yields to rise, and interest rates in the long end, the short end. What is really causing all this? And, to me, if you look at the markets and the way I broke down into break evens, which is inflation expectation, there was a gap between the two. So inflation expectation, although it's increasing, it's not really explaining what's driving 10-year yields higher. I looked at the default risk in the US. It's also not increasing drastically, although we may have an opinion that it should be higher. The market is really not pricing that in as much as you would think. And so the last part of it was really our central banks selling treasuries. And a lot of people like to say that, especially in the gold community, central banks are selling treasuries. It's not true. They still hold record amounts of their positioning in U.S. treasuries and holdings are still at record levels, believe it or not. And the fourth thing that I talked about was the flood of issuances, which I think is the more obvious take on treasuries. Now, let me, talk about another one that I think it's sort of happening in the sidelines that I think it's going to be increasingly important, which is the risk, or not the risk, the probability of Trump actually returning to leadership. I think that is, number one, in my opinion, highly likely. I think it's probably going to be a landslide type of elections, number one. And that's why I'm paying very close attention to, what are his policies? What is he trying to accomplish? What is what is likely to change in the macro scenario as we see that becoming more and more of a certainty. My view, it will be the case. But if we go back just to the 10-year yield behavior when Trump got elected, it basically we saw an increase of about 200 basis points. It's 1.8, but it's about 200 basis points of an increase in 10-year yields at that time. Now we were at about 1% at that era, if you remember, and today we're starting at about 4.5%. You add another 2% here. We are talking, over 6% yield in the 10-year, for instance. And I would suspect that in an environment where yields go even to 5%, let's just say I'm wrong, and maybe we just see 100 basis points rather than 200 basis points increase. What would that do to equity markets? And I'm going to add another thing here. Why does Trump, the likelihood of Trump coming in really increases or puts upper pressure on 10-year yields here. So let's go to the next chart. Well, the main reason for that is because his policies usually evolve around spending a lot of money and cutting taxes and so forth. And that has an effect on budget deficit. And so if you look at Trump, and I was actually being kind here, I took out what happened during the COVID recession, because the COVID recession basically, whacked all the numbers in the macro space, and especially budget deficit, which went to minus 20% in this chart. So let's just look at the period when Trump was elected and his presidency begins, and then what he did with the budget deficit. Now, I'm not here to say that Biden is a saint in terms of government spending, by no means. In fact, I think if he wins, and I'm wrong about this probability of Trump winning, I don't think the picture will change much in terms of spending. So that's just the other side of it. But the more importantly, if I am of the view that Trump has a high probability of winning, I want to understand what type of presidency or what type of economy did he inherit when he came in 2017. He was elected in 2016. He came in 2017. Well, I can tell you there was no inflation, essentially, especially in consumers. We didn't see much of the upper pressure we're seeing today on inflation. That was a phenomenon that really happens after the COVID recession and the stimulus that came out of that and all the policies we saw coming out. So this is a very different economy in 2017. In fact, that's why 10-year yields are starting at a much higher level than it was back then. Now, if we do see him using the same strategy, which I think it's going to be remarkably similar, it's usually potential for more tariffs. I think a lot of people are paying attention to that, but really more government spending to create growth. I think the bond market is not going to like that. And I think the bond market's starting to sniff that. And I think gold is starting to sniff that too. Let's go to the next chart. And so what I believe it could happen here is maybe not an intraday movement like we saw with the BOE. If you recall, the BOE, the Bank of England, had a situation where they passed a tax cut, and the market didn't like that because they thought it was completely out of their disciplinary approach, which no central bank has that whatsoever in this era we're in. And therefore, what caused investors to actually sell UK gilts, which are their version of US Treasuries. And we saw one of the biggest declines and one of the biggest moves in that instrument in history. So I'm looking at here at the UK 10-year yield spike, as you can see there, which kind of marked the beginning of an upper movement in that trend. As you can see, the upper trend of the 10-year UK yields. I think we could see something similar to this, especially because of the amount of leverage in the system. And I think the market is starting to lose patience with the lack of discipline that we're seeing from governments overall. And to me, Biden and Trump, in terms of being disciplined and making any changes from this monetary and fiscal disorder we're seeing, I think it's basically no difference. I think we're going to see just a continuation of those trends. And unfortunately, I think this is negative for the country. But outside of my political views on that, I think that the macro environment, or what sets the stage here, is reinforcing our idea of owning hard assets and being very careful with financial assets at these valuations, as cost of capital continues to show that it's likely to stay not only higher for longer, but maybe even a little higher than it has been recently. So let's go to the next chart, because this is just the Bank of America research I pointed out, and you can see here the investors still are overweight bonds, in a large way historically. That's a little scary as well. Let's go to the next chart. And so it's an example, just looking at the GLD. I had a chart just showing the 2-year change of the assets under management across GLD, showing that really we haven't seen really general investors to start buying into gold, because once we see that, we're going to see this instrument is going to start going higher, meaning people, the general population, starts to buying into GLD or other gold assets, related assets, in order to kind of supplement their portfolios in different ways, especially given the volatility we're seeing in fixed income space, which is usually driven by an inflationary era that a lot of people are not understanding what's really going on. But that's usually what happens is inflation starts to rise. It creates volatility in the fixed income markets. And it's also going to translate into the same thing into FX markets too. But let's go to the next chart. Let's keep going. So what causes a 10-year yield rise and interest rates rising? Well, at some point, it translates into higher financial conditions. And what surprises me is that financial conditions have tightening drastically recently. Now, the way people measure financial conditions have not risen as much, which to me, and I would say to money managers like ourselves, it's an opportunity. Kevin was talking about JNK, or I should say more specifically about credit spreads and the risk of them starting to really blow out. And we see the even more of a traditional way of saying that the tightening of financial conditions is happening. And the white line that you're looking at is a Goldman Sachs Financial Conditions Index. And basically that measures, credit spreads. It measures the volatility in equity markets, the valuation, the PE ratio in equity markets. And as we all know, those things have not moved yet. Market's still expensive. Volatility is still suppressed despite the volatility increase recently. Credit spreads are in the dumps. I mean, I haven't seen credit spreads this low in probably decades. And so those things are yet to move. And the main indicator for that is the red line in this chart, which is a 10-year yield. The 10-year yield starts to rise. It causes everything basically to rise, or at least it pressures those things much higher. And so I am paying very close attention to this trend of the 10-year yield. I think, as I said, it's a chronic issue we're seeing. We're not seeing central banks buy as much as they used to relative to how much we're seeing of issuances. If we have a Trump election, a Trump president being elected, I think there is a potential for even further government spending personally. If that's the case, I think the 10-year yield could be a lot higher as well. Let's go to the next chart. Now, you can see here that there's a link between treasuries and 10-year yields. And it sounds crazy, but a lot of people will look at this chart and tell you that there's no correlation between where cost of capital will be and equity markets. But I can easily see a narrative shifting towards people saying, oh yeah, the equity markets is falling because the cost of capital is higher. And so we got to discount those free cash flows back to that discounted present value of a business. And therefore it justifies why we're seeing a declining in the valuation of financial assets. But people are still not thinking that that's a potential or a possibility of a narrative. And it's the case just because of the AI euphoria. We've seen sort of things kind of shift. And look, things can get very irrational, and they've been very irrational recently in terms of equity markets, continue to go higher despite the fact that we have, even in this case, yields proving to be, a drag on the supposedly on the valuation of equity markets. And so this is a big dilemma in the macro community. Say, how in the world can 10-year yields continue to go higher and the market not really show even more of a painful environment? I think this is sort of coming. I think people have kind of lost their sort of their grasp for risk overall. And I think this is personally, I would be very careful with assets that are historically expensive, and that's in particular the white line in this chart, which is Nasdaq. Let's go to the next chart. There's way better things to be buying, in my opinion. But here is an interesting thing that is happening also in the composition of the federal debt today. Now, if you looked at the government debt, you can break it down into three parts, just very simplistically speaking. So you can see that there's a long-term debt, there is sort of the medium-term debt, those are the notes that people call, and then you got the other section that is called the short-term debt, right, which is T-bills and so forth, mostly T-bills. And what is interesting is that if you just focus on that big section, which is long-term, today it's about 12-13% of the overall debt. Now you can see this chart is going back all the way back to the 1970s. And we have never seen a time since the 1970s where the composition of long-term debt has been this high. Now, I know Druckenmiller went after Janet Yellen, and then Janet Yellen said, well, look at the duration of the debt. It's one of the highest we've seen in history. Well, the point being is that this is unsustainable, because if 10-year yields are starting to rise this way, and the government, or I should say, especially the Federal Reserve, is sort of losing a little bit of control over that, where does the Federal Reserve have control over? Usually short-term debt. So in my view, if we go to the next chart, we're probably going to see short-term debt becoming a larger percentage of the debt over time. And it's about 20%. So it's about 17% of the debt short-term is what it is relative to the overall federal debt. I think we're probably going to go to a world that we can see maybe 50%, maybe 60%. So, rather than capping 10-year yields like we saw back in the 1940s, where a lot of people talk about the yield curve control, I actually think we're going to see yield curve control happening more on the short end, and allowing the yield curve to steepen as well, and maybe carrying a much larger percentage of the overall federal debt in short-term instruments like T-bills. And I think that's probably going to be what the outcome is for the government. And this is one reason why, we have a position in the steepeners. It's not the main reason. It's one reason. The second reason is the fact that we've been, with the yield curve inverted for so long, and usually that's not sustainable. Usually we tend to see a steepening of the yield curve. And usually the steepening of the yield curve is also a recession play, which we've seen. We've gone from everyone expecting a recession to now a no lending, which I'm going to show a next chart, I believe. If you go to the next one, next chart. Okay. Well, I don't have that one there, I guess. But anyways, maybe I put it in the wrong order. But anyways, so my point, if maybe go back to the price chart just to finalize my point. So yeah, what I think it's going to happen, if you look at the cuts, we went from 7 cuts being priced in the curve at the beginning of the end of the year of 2023 to now only less than 2 cuts are now priced in. So if you think about that, it's 500 basis points or 5% of a move in the Fed funds expectations, right? And so to me, that's major tightening. In fact, if you look at the 2-year yield and the 10-year yield and the 5-year yield, all yields basically went up almost 100 basis points, to be precise, close to 80 bips or 0.8%. Those are very significant, tightening effects of monetary conditions in the economy that I think a lot of people are not paying close attention to. In fact, if you looked at the earnings, the corporate earnings that we measure, outside of the mega cap companies, if you look at just the broad market, even if you looked at the smaller businesses like Russell 2000, you're going to see that there has been a contraction of fundamentals already unfolding across the broad market. What it hasn't happened yet is just in the big companies. And so that, I think that there's a lot of issues that people are kind of overlooking, and the risk of a recession is still here, and especially when you have the risk of the steepening of the yield curve, the what's happening with the 10-year yield, and how much we're going to see of issuances of that this year. I think there's things that people are not considering as large risk. But let's go to the next chart. Now let's talk about commodities a little bit. The Biden administration is haven't officially said that, but looks like it could be looking into starting to sell some of their strategic petroleum reserves again. Well, that comes as no surprise. We have elections coming up. There's a problem here. 10-year yields, or I should say, not only 10-year yields are rising, but also oil has been rising. If you ask me, I think every commodity will probably retest the levels that we saw during that Russian invasion levels that we saw. If you looked at agricultural commodities as one example, to me, that's a roadmap for most commodities. You can see gold already doing that. Copper is close to doing that. You're probably going to see silver doing that as well. And in my view, oil is very likely to do that as well. And if we do see an environment where oil is trading at those Russian invasion levels, we're talking $130 a barrel. So if you go to the next chart, here you can see one way to kind of model this. So the red line is looking at the inventory, crude inventory in the U.S., which includes SPRs, or strategic petroleum reserves, that the government is supposed to be using at moments of a real problem going on globally. And maybe you can argue that that's what's happening right now. I would argue that's more election driven, to be frank. But as you can see here, if we're going to drive the inventory lower, in other words, sell more of our strategic petroleum reserves, you can see that there is a link between the inventory of crude versus actual crude prices. And so in this chart, you're seeing an inverted line of the crude inventory. So if the red line is increasing here, it means that they're selling strategic petroleum reserves and other types of inventories that they hold. And I'm referring to the US. And the white line is just showing WTI oil prices. And so there's a catch up for oil prices still to in my view, to do. And I think that the white line could easily be trading at $130 a barrel in an environment, especially with a geopolitical premium that I believe it's not really priced in the curve whatsoever in the energy space. So let's go to the next chart. Now, another thing that somebody pointed out on Twitter, I can't find actually the source of this person who put out, otherwise I have no issues giving out the source. If somebody knows their source of this chart, I'm happy to give them the shout out for this great research, but basically showing out the Saudi Arabia current account. So basically it takes into account their current account, how much you're spending to do all these infrastructure developments and investments they've been doing recently. And how does that sort of integrate with their break even to produce oil? And you can see that their break even price is increasing. In other words, it's going to take time for them to start really increasing production as the break-even price increases over time. So it's going to become increasingly difficult for the Saudi Arabia to increase their production as the break-even price starts to rise even further. So it creates even more pressure on the supply side of oil. That's really the sort of the resolution of this chart, in my opinion. Let's go to the next chart. And so one of the most important charts that I actually saw in a presentation recently from a Clock Tower group, and this is a very important chart. When I said there is no geopolitical premium being priced in oil, look at this chart. It's sort of fascinating how much Iran actually has been really piling on enriched uranium recently. This is, if you want a war indicator, look at this chart. And, it kind of, say, by the way, again, I'm not political at all. This is all macro data. I'm just analyzing what I think it could happen. And to me, this is a risk for Biden as well. I think this weakens his own political force as we approach elections. I don't understand why Trump hasn't used this against him, to be honest, but it is a shocking chart to look at how much Iran has increased their inventory of enriched uranium since Biden's presidency has started. And so it is a little scary chart, certainly. And I think that it's, to me, that points out as another risk for that is not priced into the oil markets too. But let's go to the next chart. So now I put out this chart together, and this is, this goes to Larry Lepar, a friend of ours that actually sent an email recently and actually added to his own letter. He does great work. You guys should read his letter, by the way. Go to his website. I don't remember now his website, but just write down his name on Google. and you will find his research letter that he put out recently, in which he actually included some of our charts, which we're very appreciative of that. But not only that, he's got this really interesting chart that was sort of old research done, that sort of shows how much was the share of the gold space, including gold itself, the market cap of gold. How do you calculate market cap of gold? Is gold above ground times the actual price of gold, and then you take the overall aggregate market cap of the gold miners, and then you add both together and you divide that by the global assets amount. So what I did in this chart, I only added the 2024 figure, in which I used McKinsey and also Bloomberg to kind of help me to find that data. And I get a number close to 1% in this, which is really interesting. If I was sort of like, was this kind of arbitrary how they choose those dates? And so I went to the gold price history, and what I found is that actually those numbers, majority of those numbers happened right before revaluation of gold. And 1981 was at the very peak of the market. 1948, there was a revaluation of gold. 1932 was right before 1933 revaluation of gold. 1921, I think there was a revaluation in 1922 or 1923. But that gives you a sense of how gold's relevance was much bigger back in those days. And today, it's sort of nothing. And I do think it's going to become a much more relevant segment of the market as we move along in the near, in this next decade. Let's go to the next chart. Silver inflows. If you looked at the weekly inflows, Quinton has such a good chart, or I should say a slide in the prior presentation where he shows, how he kind of have arrows pointing, you start with gold and then it goes to silver, or it should go up. And then it goes to the miners. It kind of like how capital kind of starts flowing into those different parts or segments of the industry. And, this is just one example of showing that we've seen, if you look at the SLV ETF, the most famous silver ETF, a lot of people like to use the Sprott ETF for other reasons. I'm not going to get into that, but it still is the most liquid ETF for silver. And it's very interesting that we've seen a very large amount of inflows the prior week. If you ask me, that's the largest inflows we've seen since that period when gold and silver went crazy after the March 2020 bottom, in which we saw even the miners do something crazy. And I think the same people that are dismissing, or they were dismissing the opportunity in gold just because gold wasn't moving when inflation was really high, are exactly the same people that are dismissing the opportunity with the junior miners. So that's my 2 cents on this. But let's go to the next chart. And so, there is also a record amount of inflows coming into commodities overall, measured by the Bank of America. So I'm just showing you different types of sources that show the money is starting to flow into the hard assets in a big way. And it's yet to actually drive or re-rate valuations of things that we think will be re-rated, that are still historically cheap. Let's go to the next chart. And so copper is one of our main investments as well. I think copper is going to do exactly what gold did. And it's in a very interesting sort of roadmap. If you think about gold, when gold was trying to break out from to a historical high level. And to me, this potential for shortage of energy, or I should say shortage of electricity, given what's happening. And I think Elon Musk actually has been covering this extensively, sort of talking about, he breaks down into 3 parts. It is electricity coming from heating that is changing. I mean, New York, you can't buy a stove if it's not electric stove. Those things are happening across the globe. Electric cars are also increasing electricity demand. And number 3 is, according to him, that it's going to be also even more over the years, is going to be AI. And that is not to include the actual existing demand that comes from electricity that we've seen. And so utilities, if you look at the estimates for utility companies in terms of their own revenues and so forth, is starting to increase as well, because people are starting to realize that there's issues happening across, I guess, the global economy in terms of the shortage of energy risk, that it will be caused by, all these different segments as well of electricity demand that is going to be driven by cars and heating, and also AI. But copper is sort of a fundamental sort of commodity that falls into this electricity demand and infrastructure and revamping of electrical grids. And it's likely to be one of the things that will be a way to sort of express that view in markets today. And so I think the world where copper can be trading at 6, 7, 8, we could see that. And I strongly believe that will be the case, just like it's happening with gold. In fact, if you go to the next chart, it kind of shows this correlation between copper and gold. We all like to be cute and say, well, copper has more volatility and all that. They're basically the same chart. If you just close your eyes and you bought gold at cheap prices and you sold at high prices, you probably also bought copper at cheap prices and sold copper at cheap prices. If you ask me, if we're at the beginning of a cycle for gold, it makes me also believe that copper could be at the early stages of a movement as well. Let's go to the next chart. I'm almost done. One thing that's been happening recently that I think it's an opportunity as well, that also still is really cheap and find it hard to believe that won't be linked to this potential for a gold cycle, is certainly what's happening with Brazil. Brazilian markets have actually been hurt recently with what's happening with also what's happening with Elon Musk and the leadership, political leadership in Brazil that has been suppressing freedom of speech and all sorts of things. And investors have started to sell some of their assets. No, I don't think this is, the fact that we even talking about that we have this level of transparency today relative to what was back in the 90s is great. I think that's actually noise relative to the opportunity I had. So to me, it's hard to believe we're going to see gold taking off and not see emerging markets also do very well, especially resource-rich economies. So to me, this is an interesting a tactical but also structural opportunity over time. And if you go to the next chart, I've shown the charts of Brazil breaking out, and guess what? We're retesting the line right now. So if you like technicals, this is a chart you should be looking at it as well. I'm a big fan of Brazilian equities. I think they're one of the cheap opportunities out there, different than, and remember that AI paradox idea I've talked in the past, which, I think is going to, to paraphrase other experts in the space, it's going to equalize the labor market across the globe. And if that happens, the efficiency level of most Brazilian companies and other emerging market businesses is likely to also improve drastically. And that's certainly not priced in to the multiples of those companies. And so this is another opportunity.